Hey everyone, you're probably wondering what this thing is, inflation. Like, how real is it? Is it, transitory? Is it permanent? And how is it going to affect apartment buildings? And that's what we're going to talk about here in this video. So let's do this. All right, to help us unpack this, we have on the show today Drew Kniffin, president of Nighthawk. What's going on, Drew?
Hey, Michael.
All right, so how real do you think inflation really is?
Well, for our generation, we don't know it as well, but from our parents' generation, they know that it's very real. And if you don't move against inflation, it's going to move against you. That's the reality. Inflation is it's the price at which money is effectively being stolen from your pocket. It's the same thing as someone just taking your money from you. And, for instance, 5% inflation means $100,000 that you have today is only $77,000 in 5 years. So it's a reduction in your money.
Yeah. Okay. All right. So what evidence are we seeing with regards to inflation in the economy right now?
Well, we're seeing a lot. The Federal Reserve, which basically controls our money, targets 2% inflation. And they used to say that 2% inflation was their max. Now they say they want an average of 2% inflation, which is code for we're going to be more flexible. Well, what we've seen recently is that in April, inflation went to 4.2%. And then in May, it went to 5%. And one of the economists that I follow the most, Jared Dillon, expects 10% inflation in a year's time.
Well, I think we're seeing inflation all over the place in various different ways, in real ways. I mean, obviously, everybody's talking about the price of lumber, right? You're building anything, a treehouse, a deck. Lumber is crazy, right? And so, therefore, also the cost of construction has been going up as well. I mean, there's so many different ways that we're seeing price increases.
Yeah. We're not just seeing it in wood, as you're saying. We're seeing it in wage inflation. We're seeing it at our apartment buildings. We're seeing it in the cost of food. We're seeing it in the cost of fuel across the board. People already know this if they look at their pocketbooks, but the prices are going up.
So why is this inflation thing happening? Like, what's new?
Well, there's simply two things that are always in motion. The amount of dollars are out there, and the amount of goods and services that dollars are buying. And so if more dollars get printed and there's the same amount of goods and services, then the more dollars chasing the same goods and services means the prices go up. It's simple. So here's an easy fact to put it all together, Michael. 30% of all dollars printed in the history of the United States have been printed or created by the Federal Reserve in the last 10 months. That's amazing. And if you just think back to what I just said, supply and demand of dollars, inflation is always going to happen when too many dollars are chasing too few goods and services.
Well, that's right. So we have a huge influx of dollars coming in. And I remember I just listened to Peter Schiff today on a podcast. There's some kind of consumer spending index, which is like 6.4%, which is outrageously high. Normally it's like 2.5%.
Right.
And it's all this consumer spending. Well, it's not from productivity. Right? We actually lost a boatload of jobs. So it's not because we're more productive. It's because people have more money in their hands and they're spending it. And therefore, coupled with the fact that there's a supply problem caused by COVID, people weren't able to work, couldn't show up for work, didn't want to show up for work because of the unemployment benefits. So everything is being held up. So there's a huge demand now with all this free money. People want to buy stuff, but there's no supply. And so there's this giant gap. And so this is why we see prices being driven up. The big question is it going to be temporary or is it permanent? What's your opinion on that?
I think so most officials are saying it's going to be temporary. I think it's going to be more permanent. When we print $4.8 trillion in three different bipartisan stimulus bills in the last year, and then another $1 trillion just announced a few days ago for infrastructure, that's not an insignificant amount of money, and that's not just going to go away in a short term. So I do think we're going to have a significant season of inflation in front of us.
I agree. I think also psychology. I mean, if it's taken us 12 months to get used to, the price of wood, just simple basic stuff. It's taken us 12 months to get used to not getting what we want when we want it, And so why would that change? Why would anyone now reduce their price? Like, what would cause them to do that? They're not going to reduce the price. They're going to keep it where it is. And now, hopefully, if their cost starts to go down, their profit actually gets back to where it was before COVID. So I agree with you. I think government's going to continue printing money because it worked so well before. And there's no reason to lower prices. And people are not going to expect it. So I think it's here to stay as well.
people always say wages are sticky, right? So no boss can go say to their employee, "Hey, listen, inflation is down. So I was going to pay you $80,000 this year, but now I'm going to reduce your salary down to 70,000. Sound good?" I mean, no one's going to put up with that. So prices are sticky, is what you're saying.
I think prices are totally sticky. Even if some people say, "Oh, the supply chain issue will be fixed," which it will, but I think there is price stickiness on both sides of it. So I think we need to start thinking more about inflation. The next question is, well, that's great, but this sounds kind of like bad news because now my hard-earned savings in the bank are being eaten away by this inflation. The $100,000 you said, this time next year is going to be worth substantially less, and certainly in 5 years. So how does this affect real estate or apartment building investors specifically?
Yeah, so there are some industries that do well in an inflationary environment. And surprise, surprise, we are one of them. So you think about them, usually people think of commodities, core services, and real estate as the things that are great inflation hedges. And so that's one of the reasons that we love our business, because we think it can do well in a recessionary environment. We think it can do well in a normal environment. We think it can do well in an inflationary environment. It spans all those different areas. So I like being in real estate in an inflationary time.
Are you seeing any kind of increase in, like, say, rent? So is there any increase in rents that we've been seeing that might be explained by inflation?
Well, it's hard to dissect the two, right? So we see rent increases every year across time. Even during COVID, we saw a lot of rent increases, honestly. But some are due to just value creation. Some are due to just making the product better, and some could be due to inflation. So it's really hard to dissect those two. But I think that we are seeing a pricing tailwind that's assisted by all of the money that our tenants are getting in rent assistance, for instance.
Yeah, there's no question. And somewhat related to this, I was listening to Doug Duncan, the Real Estate Guys Summit, the chief economist of Fannie Mae, and he calculated the total stimulus for the average household was something like $11,500 to date.
Yeah,
and
I believe
with
that. 100%.
With a 3% down on an FHA VA loan, you could buy $386,000 of house, and the median house price was below that, and so not surprisingly, we have seen this giant influx in house prices because people are, guess what? They're buying houses with it. They're paying their rent with it, and in an environment where there's a lack of supply of good quality affordable housing, people are competing against us. I think we are seeing the effect of that. I mean, in several properties, we're getting rents that we're not projecting in year 4 and 5.
A lot of them. And you think about it like this, Michael. Inflation is the cost of things going up. Well, the cost of things going up is measured in a technical thing called CPI, the core pricing index. And get this, 40% of the CPI is housing. So when inflation goes up, that necessarily means that the price of housing is going up. Well, we're in the business of providing housing. So in that sense, inflation is good for our business because it means that we are having increasing pricing power on our rents in our properties.
That's a great point, Drew, because I want to show you guys what happens in numbers to an apartment building or any kind of real estate with inflation. So would it shock and surprise you that I created a spreadsheet? So I created a spreadsheet, and I'm going to take a look at it right now here. We're going to take a apartment building, and we're going to assume that we're buying it for $1 million. We're putting 25% down. We're getting a 4% loan, 30-year amortization. The cash-on-cash return over the life of the investment is 7%. And let's say the rent increase / inflation is 2.5%, and the cap rate is 6%. Okay, so what I'm going to show you is that why real estate is actually good, why inflation is actually good for real estate. Because what it does is it increases our rents and therefore the value of the building as well. So check this out. So we got rent growth due to inflation is this is a normal environment. This is pre-COVID, right? Rent growth due to inflation, so this should not be, so therefore there's our income. And I'm just going to go down here. So we have this normal thing where the rent goes up 2.5% per year, which we may actually use in our projections. And you see here that slowly the cash flow goes up. You can see the debt service coverage ratio going up over time. And so what happens now is we have an appreciation that down here from this rent growth, and it's about a 10% average annual return just from the appreciation of the increased cash flow from this rental growth. Now, there's some appreciation from debt repayment because inflation actually has a consequence on debt also, because we love the debt because inflation erodes the value of the debt as well. So inflation is great for that as well. So therefore, we got to look at the debt and the appreciation as well. So we have the total appreciation of our expected 15% average annual return in each of these 5 years. Okay, so now check this out. So down here are the returns adjusted for inflation. So that 15.5% return, if you have a 2.5% inflation, is actually 12.5%. Okay, so we have to be fair, okay, because inflation eating away against the returns. So that appreciation return in next year is going to be worth 2.5% less. So this is the environment we've been operating under. Now, let's just for grin see what happens if inflation goes to 10%, just to be a little extreme. I don't think it's, it may not be likely, but certainly 5%. But let's just do 10% just to make a point. I'm just going to change this. What happens now is my rents go up per year 10% because inflation is going up. So you can see here what happens to the cash flow. You see the debt service coverage ratio is going up more and more. Why? Because the debt is fixed, right? So the income and rents, both income and the rents increase. Now expenses increase also. Okay, you got to be in fair. They both go up by 10%, but the gap widens. Okay, the NOI widens. You see this widening gap here, right? Because there's a difference between income and expenses. The gap widens, but the debt nevertheless stays the same. Therefore, our free cash flow goes up every single year. And you look at the average annual return right here. Now, the pay down of debt is the same unless I choose to pay down debt early. So that's the same as in the previous example as well. But look at the total appreciation. With a 10% inflation, my average annual return jumps to 45%. Now, you have to adjust it for taxes, but look at that. Even after tax adjusted, I'm making a 30% average annual return after taxes. And that's what I love about real estate. So inflation increases our rents, which increases our NOI, which means our cash flow goes up, and the value of the building goes up disproportionate to the inflation. This is why real estate is a fantastic hedge against inflation. All right, let's recap here, Drew. What do we need to remember from today's session? Should we run for the hills? Should we do something else?
It's quite simple. Inflation is good for real estate. So we see that when inflation goes up, so does the value of your rents, so does the value of your building. But most importantly, your biggest expense, your debt service, is fixed. And so you benefit from that. It's one of the big reasons why real estate is a big winner in an inflationary environment. That's the lesson.
Awesome. So if people want to start taking action, learning a little bit more about what it's like to invest in multifamily syndications, what are their options?
It's quite simple. Join us at Nighthawk Equity/join, and you can on that site grab a phone call with our team and make sure that you're a good fit for our organization. And if so, we'd love to have you join us on one of our inflation-resistant assets that we're buying all the time.
Yeah, so it's nighthawkequity.com/join. If you're not quite sure about it yet, schedule a call with us anyway. But there's also a really cool report you can get at themichaelblank.com/report that compares the stock market to real estate. And I talk about some of these things in also real terms in that report. So go ahead and download that as well. Either way, we look forward to having a conversation with you. And again, it's not time to run for hills. It's all about raising your level of awareness so you're not taken by surprise. So you can position yourself to not only survive, but thrive in this environment. So great. Thanks, Drew. Appreciate it. Catch you guys next time.